Let's go big to begin with, though, in the form of SSE. This is a plan which has been awaited for some time, it feels like, by shareholders, certainly in light of National Grid doing something similar last year. We all know the country's electricity networks, the country's grid needs upgrading in light of the challenges to come. So, Valeria, why don't we start by talking about the investment plan itself and how the market responded to the news?
Yep. So SSE reported its half-year results yesterday, but as you say, it came alongside some big news. So the company announced a huge 33 billion investment plan, and as you said, the goal is to upgrade the UK's electricity grid by 2030. But that's a big jump from its previous target of, I think it was 17.5 billion out to 2027. But yeah, most of the money will go into the nuts and bolts of the grid. So about 22 billion is for high voltage lines in Scotland, another 5 billion for lower voltage networks in Scotland and southern England. And then there's around 4 billion going into renewables and then about 2 billion for other projects. But yeah, as you said, the idea is to build the grid that the UK needs for net zero power by 2030, which essentially what that entails is moving clean energy from remote wind farms to where actually people need them. But yeah, from a financial point of view, the company said that the plan should more than triple its regulated asset base. And by 2030, around 80% of its cash profits will come from regulated returns. Those are the earnings that effectively are set and approved by the UK energy regulator, Ofgem. And in practice, that means much more steadier and predictable income because Ofgem essentially guarantees a fixed rate of return for the money that SSE invests in its networks. And in terms of the market reaction, investors clearly like the sound of that because the shares were up 12% on the day.
So this plan, how will it be funded? Because there are a number of routes which SSE is going down to raise the money. Can we say a bit more about that?
Yeah, there's quite a few. So it's a mix of new equity, borrowing, cash flow, and asset sales. I guess the standout bit from the plan is plans to raise 2 billion by issuing new shares, that's roughly a 10% increase in its share count. And yeah, it will use that as a bit of a upfront firepower. Then about 21 billion will come from the cash its existing power stations and electricity networks generate over the next few years. And then on top of that, SSE wants to take on roughly 14 billion of additional debt and hybrid capital. And then finally, it plans to raise another 2 billion by selling Northern Core assets, although it hasn't given a lot of detail on that.
Yeah, so there's quite a few aspects there, as you say. The equity raise was relatively low in the grand scheme of things there, and there are some analysts who think maybe it's a little light on that front, albeit it might be some time, I imagine, before we find out whether that's true or not.
Yeah, that's the one thing that analysts aren't entirely convinced about. So Citi said that the equity raise itself was much anticipated and a logical step for the company, but I guess the size of it is much smaller than they would have liked, and probably not enough to fully repair its balance sheet. Just given how ambitious the 33 billion investment plan is, but SSE is targeting a net debt to EBITDA ratio of below 4.5 times throughout the program, which is sort of roughly in line with National Grid and should keep things manageable.
Before we talk a bit more about the share price reaction, let's talk a little bit about the results themselves, because they've understandably been overshadowed by the future plans, but the figures were a little bit underwhelming in and of themselves.
Yeah, they were fine, not fantastic. So adjusted pre-tax profit fell 28% to about 521 million, and that was mainly because its renewables division had a bit of a weaker spell. So there was less wind and rainfall, which obviously hits generation, although it has more capacity online now. Earnings per share were broadly in line with expectations. Operating profits were only slightly below. Management also reaffirmed its guidance for 2026 and 2027, and net debt came in as expected. But yeah, I mean, as you say, it wasn't really the results that moved the market. It was the investment plan and obviously the equity raise that grabbed people's attention.
Alex, I want to bring you in now. Maybe we just take a step back and first of all, and think about what this equity raise says about market appetite for this kind of thing. Again, we all knew this was coming to a certain extent. We know the investment needs to be made. What's your take on the big picture for you?
Well, I mean, the first thing I'd say is it's great to see. I think in the stock market we spend a lot of time talking about prices and performance, which of course matter, but it's easy to forget that the stock market should look a lot more like the bond market does, which is a place where you can raise money and where capital formation can happen. So I was just thinking, imagine if a company this week had just IPO'd and they'd raised £2 billion to float. They'd raised another £14 billion in debt, and they promised a massive program of national infrastructure upgrades that's going to act as a big economic multiplier. That would be huge news, and that's kind of close to what SSE has done. I think it just won't be seen that way because we have a quite sort of myopic view of public markets, and particularly with this in this sector, because we have a tendency, and it's justified in a way, to see utilities as asset owners, and we overlook the thing that they can do very well, which is build. And building means growth rather than sort of simply collecting rents. So I think it's a real, like the National Grid raise, I think it's a real positive that you can see the stock market, doing the thing that it was kind of built to do, really, albeit, in a limited capacity relative, as Valeria said, to the proportion of hybrid capital and debt that is also being taken on to get this plan over the line.
Do you think, is it possible to break down why the reaction was so strong? Do we think it's a combination of all these things we've discussed a little bit about the fact that the equity raise is relatively small, a little bit about the uncertainty being removed rather than added to because people have been waiting for some kind of announcement on this front, but also maybe what you've just spoken about, perhaps in some ways, not that the stock market itself is sentimental, but people saying, well, actually, this is an attractive plan. So even though the share dilution is going to be what it is, we're looking forward to the growth prospects and seeing this as a sorely needed investment.
Yeah, I mean, definitely. There is so much money out there, whether it's, it impacts investing capital or just pension funds even, who are natural owners of this sort of debt and equity, very long-term infrastructure assets in the UK. They are, they're going to want to invest in this sort of thing. So there is money out there that, wants to get into this sort of thing. So as the question of why the reaction was so positive, you can't just put it all down to enthusiasm for a great plan, but to do this sort of thing, set out a plan, cost it properly, get the financing on board, it does require so many things coming together at once. And what it does is, analysts, and we can come on to this, the sort of valuation in a minute, but, analysts did have earnings per share at about 230p by the end of the decade, which is what they're talking about this program's going to deliver. So in a sense, it's not a huge change from what the market's expecting, but this, they were never going to get there if they didn't announce a big financing. So this event de-risks what the market, what investors hope for long term. And obviously there are variables here, but the actual act of getting this, all the parties together to agree this and make it work for the SSE's capital structure, is itself, it is itself deserving of a kind of premium that we've seen pop up in the last day since the announcement.
Yeah. Well, on the subject of the valuation, what's your take on that now in light of this? The shares have risen a little bit, but It's still at a discount, I think, as Valeria wrote in her piece, to the likes of National Grid. Do we see this as a potential for that to close in future? Do you see the valuations attractive, in short?
Yeah, it's a hard question to say compared to National Grid, because of course they have the US business there, and that means different things. That's a different market. It's got a different investor base as well. But to the point that Valeria raised, that they are, they're keen to sing, is the regulated assets that they're going to end up with by the end of the decade, and what that does for earnings. So because of the way that the UK's energy market is regulated, that builds in a degree of reliability and consistency and predictability to operating profits, which if you're investing in the utility, you kind of want to see. So that's the first thing to say. There are obviously variables. We don't know what is going to happen to interest rates in the next few years. Fortunately, SSE have got most of their debt locked up in bonds and at fixed rates. So if there were changes, dramatic changes in interest rates, they wouldn't be felt quite so quickly. But when you're leveraged at 4.5 times profit, it doesn't take a huge amount to knock your expectations if, say, interest rates, did push up back towards 6%. Anyway, those are very long-term hypotheticals. In terms of boiling it down to the valuation, so like I said, consensus had adjusted earnings at about 230p per share by 2030. So at the end of this 5-year cycle, they've got now a target range of 225 to 250 p. So there's this kind of relatively predictable step change from an earnings multiple of about 15 now to 10ish at the end of the end of the decade. And the dividend, which for some SSE investors, that might be the thing that they're really, really focused on. That's currently, I think last year was 64p. They're predicting that the earnings growth is going to underpin a 5 to 10% per annum growth in the dividend. So you're looking at the yield moving from about 3% now to between 4 and 5% by 2030. So it's just a very, very clear equity investment story there, that the capital is going to grow, and so might the income case. So yeah, I mean, that's another reason why people really bought in yesterday, because it's de-risked it, but it's also just got a quite a clear story now about how it's going to make shareholders money.
Yeah, maybe a little different as well from National Grid, which some people now say very much shifting from income to growth mode. SSE is trying to do both, and if it can pull that off, then clearly that will be worth something. To wrap up, we should talk about the wider implications, take a step even further back perhaps, because with the amount of investment the grid needs, I mean, there has been a lot of talk as well about increasing consumer bills, that kind of thing. So there is that question of whether companies like SSE, of course, are relatively bound by what Ofgem, the regulator, permits them to do. Whether the regulator has got that right, clearly it needs to balance the need for investment and getting companies like SSE to invest. But at the same time, bills might increase. There's going to be some concerns about that, given the way bills have already gone in recent years. Do you have thoughts on that balance and the ability of the regulator to strike the right balance there?
Yeah, I mean, it's a really, really tricky mandate, and there's not a right answer here. Like you say, it's got to try and protect consumers, but it's also got to support the transformation of the grid into, from a kind of a gas-led one to a clean energy and electricity-led one. Really, really, really hard job. And it was all this upfront capital investment, which especially isn't easy when we're still dealing with the aftershocks of 2022 and a wholesale energy market that is still modelled on volatile fossil fuel prices and a frankly stupid just-in-time delivery network that we have in the UK. So we've got really constrained capacity to stockpile gas when prices are really low. So anyway, I mean, my view is that I think the best way to protect consumers in the long term is to move to renewables plus nuclear. Obviously, selling that politically is a really tricky one when it is lumping on, when bills are high and not coming down. So, Ofgem and the government, they need to make this case forcefully that, better times are coming. I do think better times are coming for the UK energy market, but it's a tricky few years ahead. I think energy providers can also continue to innovate with tariffs and sort of incentivize changes in demand where possible, and we're starting to see that a bit. But it's a really tricky thing to get right. What is encouraging to see is that companies like SSE and National Grid can be part of the solution to it. Politics is a different game.